So ROI, return on investment, right? I would say returns are trash because of what I mentioned before. 99% of us are not born with a silver spoon in our mouths. We have to save up to $100,000, and that takes some time for people. But even let's say that you're able to save and you put this $100,000 at play at a 10% return, which is actually a very good return. That's about 800 bucks a month. You're not going to be rich off of 800 bucks a month. You're not. It usually takes about a million plus in order to start living off of your return.
Most investors chase ROI. The best investors chase positioning. Today's guest has brokered and financed over $1 billion in commercial real estate, personally owned more than 1,500 multifamily units, and now he's launching a technology that could fundamentally change how investors underwrite, analyze, and scale real estate deals. If you've ever wondered why some investors survive every market cycle while others disappear after one downturn, this episode is for you. Today on the Real Estate Roundtable, I'm sitting down with Boris Sanchez, founder and president of Sunmore Investments, to break down the real truth behind cash flow versus appreciation, why ROI can actually mislead new investors, and how breakthrough technology is reshaping the future of real estate investing. This is not a theory. This is battle-tested experience from someone who's operated across multifamily, industrial, office, retail, and land at scale. Let's get into it. Boris, welcome to the podcast.
Thank you, Lancelot. I appreciate it. Thank you for that intro.
Boris, before the billion-dollar transactions and the technology platform, there was a starting point. Every investor has that moment where theory meets reality. What originally pulled you into commercial real estate investing and finance?
If I have to, start there, let's start it all the way at the beginning. So I've been a serial entrepreneur ever since I can remember. I founded my first ever business at the age of 7 years old. It was a delivery business inside my own school. Ever since then, I've owned every kind of business there is, from consulting services to car dealerships, e-commerce, and more. But 15 years ago, I joined the family business in real estate, and I've been in love ever since.
What was the first deal that truly changed how you thought about risk and underwriting?
The very first deal that I did commercially, that I invested in commercially, I bought an eightplex for $140,000. And using hard money, I was able to secure another $60,000 in renovations and came to closing only with $10,000. About a year after acquisition and renovation, I sold it for $450,000, making me effectively about $250,000 in profit, which completely changed my life and my outlook, more importantly.
That would change mine too.
Yeah.
At what point did you realize systems and analysis, not hustle alone, were the real edge?
So I've been experimenting with that kind of style of real estate, owner operating. It's not really that popular within the commercial real estate realm. More people, once they get done with the whole house flipping, they start syndicating and putting their money together to crowdfund. Hardly anybody chooses to go the route of funding their own deals, commercially, even bigger deals with debt. And so I've done that. I've played around with what I call forced appreciation and cash flow ever since then, ever since 15 years ago. And it's been very well received. I think I've made some really good money. But most importantly, I've identified several problems and disconnects within the real estate investing flow through, right? And then what you have to do at every step of the way in order to be successful at the end and make a profit. And so what my platform tends to solve is a lot of that, bridging the gap of a lot of those disconnects and fragmentation that I've seen, and which led to a lot of problems, and a lot of other folks that I know about have completely quit because of these problems.
You've operated at scale long enough to see inefficiencies most investors never notice. And recently, you announced a major breakthrough in real estate technology. Can you tell us about the technology you recently announced and what problem it solves?
Absolutely. So Rady AI it solves the problem, first and foremost, that data is scarce, expensive, fragmented. Folks have to first find a property and then find the funding for it. Both real estate and financing are related. They're very close to each other, but yet disconnected. There's no platform out there that offers you a myriad of loan options available on every single property that you see. Added to that, third-party reports such as appraisals can take months and then completely can undo a good deal. And not to mention, again, that data and the analysis of a property can be expensive. You have to have 10 different tabs open to analyze one property. We've actually solved all this with our platform called Rady, where it's the first platform ever to combine over 600 data points of data, demographics, racial makeup, income, family makeup, and all that, crime, into one platform and one and done view of the entire property and the neighborhood that it surrounds. In addition to that, every property has actual, honest to goodness appraisal report on each property, just like it comes from an appraiser, but it's actually done instantly without technology. That means that we're actually disclosing for the first time ever what your sales comps are in that particular property, what your rental comps are, and what your Airbnb comparables are. So you can make a decision about a property that you're looking at extremely quickly and efficiently. In addition to, like what I said, we are providing over 400 avenues of financing for each deal that you see on our platform. Even if you decide to not look at one of our properties, you can upload your own deal and we can provide these 400 avenues of financing already categorized by lowest interest rate, lowest monthly payment, easiest early termination structure, lowest cash to close, among others. And so we're extremely excited to bring about this technology that's much needed in the real estate realm.
So you could refinance with this technology, correct, as well?
Yes, you can upload your own deal and then get, like I said, a list of financing avenues and options.
Where does underwriting traditionally break down for investors?
I think it just because it's so fragmented and the education behind it can be missing. So some folks just go the avenue of they say price per unit and they go off of a simple division like that. Oh, I'm getting that property here for 70,000 a unit when the market is 50. That means I'm going to walk away from a deal. Or they just get a deal that they know in their true hearts to be a good deal, but they have no financing avenues for it. Or they may be interested in investing in another city, but they have no real demographics, they have no real studies of it. They don't really trust the data, they might not trust the appraisers. Our system completely breaks that down and gets rid of any bias that could be out there, shows you step by step what comparables were used on each evaluation, the adjustments, and why we think a property is at a certain price, both as is and as repaired values.
And who benefits most from adopting this kind of technology early?
I would say anybody that's interested in investing in real estate. I've never met a person that is not interested in investing in real estate. And so because of our technology, we even included what's called Rady Lingo, which is a game that helps you understand and learn about real estate investments and construction. And so from the people that are curious to the folks that want to buy their first property, to the folks graduating to the next level between residential and commercial, even to the folks that are willing to buy more and more units per property, it helps everybody down that spectrum.
This is awesome, man. I want to try it out already.
Yeah, sounds good. Yeah, me too.
And I want to level up on it. Does it work for new investors as well? Like brand new, no experience, they can get lending as well. They don't have to show track record or anything like that. Or do they need to partner up with someone? How does that part work?
Yeah, absolutely. So one of the underwriting questions that a lender wants to see is one of the most popular is how much experience do you have? But I'm here to tell you that not every lender is cut from the same cloth. And so we do have avenues for people that are, for example, professionals. They're engineers, they're lawyers, they're doctors. They're maybe teachers who have invested or saved up a bunch of money and want to buy their first property. And so we actually present them in a real positive light and guide them through the first process and make sure that they meet with a lender and qualify with a lender that can easily approve them instead of a lender that's, oh, you don't have any experience in the market. I'm sorry, there's the door. Yeah, it absolutely helps everybody from the jump.
That's awesome. We needed this program.
Yeah, we did. That's why we're inventing it.
It's awesome, man. You said something that really stood out for me. Cash flow is a wealth maintainer, appreciation is a wealth generator. Walk us through what that actually means in real world terms.
In my 15 years of experience being a commercial real estate investor, I've noticed many things, right? I've noticed that folks that want to get into it, they buy a property and they think that because they're going to make a few bucks per month, it's going to completely change their life, right? If they rent out, if they buy a house, for example, and they make 300 bucks a month, and they think, okay, it's going to be not only cash flowing per month, but it's only going to be appreciating over time. I would say they're going to have a rude awakening because usually that $300 a month is not going to change your life. It's most likely going to an AC or something breaks out and then you lost your complete profit for the year. Not to mention that organic appreciation in a house is actually moves very slow compared to the rest of the market. You might as well put all your money in the S&P, for example, and then maybe get more of a gain from it. So what I propose is something called a forced appreciation, which is when you take a property, you increase its income, you lower the expenses, and you generate more of an NOI, net operating income. That is directly relational to the value of the property. Like a business, right? If you buy a steakhouse that only sells 2 steaks a day and you make it sell 200 steaks a day, obviously that restaurant is going to increase in value. Same thing in real estate. That actually is applied to commercial real estate. 5 units or more, or anything that's not a residential homestead, can be applied. And so what I propose is basically don't rely on your 200, maybe $500 a month in cash flow, but rather focus on the forced appreciation that a property will bring you that can actually, if done correctly, that can make you many times your initial investment. And that's how you generate income, which actually, not generate income, generate wealth, and to a generational level. That's how 99% of us need to start, because 99% of us weren't born with a silver spoon in our mouth, weren't born with $1 million for somebody to put and invest into us. We need to generate something from nothing. And the very best way that I found of that doing is through forced appreciation of commercial real estate.
And can you share an example from your own portfolio where cash flow protected you?
Where cash flow protected me, yes, I can. So in a property that I had bought, that it was a very ugly property that all kinds of tragedies happened to it. I bought this 12-unit apartment complex for $350,000, and I started renovating, but it seemed that it was cursed. Everything happened to it. I got with a contractor that was affordable and a friend of mine, and I gave him the chance to do it. He started, but then there were started doing a lot of break-ins into the property, like just the local thieves started breaking in and stealing my material. We found cash registers buried in that complex with 30, 40 bucks in cash. We had a flood. We had a fire with no insurance. We had just a gamut of tragedies happened to this complex. I had to renovate this apartment complex kind of many times over, ballooning my cost to over $1 million. But I was able to lease it out at the end of it all to a company that does sober living, master leased properties entirely. And so I leased the entire complex, all 12 units out, to this sober living clinic. And because it was all income and it was a double net lease, I was able to boost the valuation of the property past $1 million. It wasn't worth $1 million on the market. It was probably worth a good 850. But because I had this lease in place and because I had this cash flow in place, other investors that looked for that kind of structure were attracted to it. And I ended up selling it for 1.2 million. I'm making a marginal profit, but at the end of it all, I was saved by cash flow and by a lease structure that brought around cash flow needed to some investors that would be paying $1.2 million for it.
That's a great story, my friend. I think every investor has one of those.
Oh man, yeah. Oh yeah. I have worse ones than that I actually ended up losing. And right, it hasn't all been roses and rainbows. I have plenty of stories that you just went into the wrong market. And especially in times after COVID, rents came all over the place and they lowered greatly. And so we weren't able to be successful in some. It's all about how you get up and you try it again on the next one.
Yeah, for sure. You learn how to fail forward.
Fail forward, always.
Yeah,
Yes, correct.
always fail forward. Where have you seen appreciation dramatically accelerate net worth?
Obviously, in my life, first and foremost, but in my students' lives as well, my clients' lives. I have a brokerage and I'm a teacher of commercial real estate. I'm a fan of it, and so I teach it. But I've seen where my students get 300, 400, $1 million in paycheck. It completely changes their families' lives. That's the power of commercial real estate. And more importantly, forced appreciation rather than organic appreciation.
Got you. And how should investors balance these two at different stages, early, mid, and late career?
I would say an early investor is wise to learn about, first of all, about real estate investing and about construction. Anybody that comes up to me, I love it when 18-year-olds and maybe even 25-year-olds come up to me and they ask me, how can I get started? How can I do what you're doing? But how can I get started from now? And the first thing I say surprises them. I would say invest in up here. Invest in your own learning and invest in your future, in the biggest asset that you'll ever have, which is your own mind. That immediately is a huge value add to yourself. When you learn about construction and when you learn about valuation of, let's say, commercial versus residential, you're already setting yourself up for a successful future because you'll know avenues to go to should the worst happen. But that's one thing that I underestimated when I started out is I did not completely know construction, and so I just went and did it. But should I go back and try it again, I would definitely learn about construction and real estate valuation first. And so that compared to somebody that's already been in the ringer for a while, I would say definitely keep that education going. You don't know everything. I don't know everything, of course, but I'm always learning. I'm always willing to learn from others, talk to others, learn from their experiences. Somebody with 160 homes out there can be considered an advanced or experienced investor. But if you haven't tried forced appreciation in your own properties, or if you haven't tried maybe liquidating your portfolio and turning it into apartments, or let's say office or warehouse or something like this, then can you really say you're an experienced real estate investor? I don't think so. You need to try it all, I would say.
I definitely want to get into commercial for sure. I sold multifamilies, I sold large multis, I sold commercial properties, land, et cetera, et cetera. I've never bought one for myself because I've always gotten into this hurdle of or the block of getting that loan. But now that you
Right.
got this program out there, I'm like, hey, this is something that I am really interested in because now we can get into commercial. And with commercial, there's no broken toilets. Triple net leases are amazing. You're like,
Right.
here you go. Here's the shell. Do what you want to do. Just pay me my money monthly or whatever.
Correct,
I'm also
correct. You can't get to that level. Obviously, those triple net leases have their own risks that other fanatics of multifamily like myself tend to avoid. What you see a lot of it in triple net leases, for example, shopping centers and big box retailers, is that it's kind of harder to fill that space after your tenant leaves. And so if you're building that nest and when you can prepare for a 6 months or a year of vacancy, then you're better for it. But yeah, absolutely. A property that has a triple net lease is highly sought after, first of all, and then second of all, it's more valuable. If you figure out how cap rates work, actually they work way better than a business valuation does. I'm not sure if you're familiar, or your listeners are familiar with it, but for example, a business is worth X times its EBITDA, right? Usually it's maybe five or so, or around there, maybe less. In real estate, cap rate works similarly off of the NOI, but it can be up to 50 times that NOI. And so when it's the cap rate is about a 2%, it can be up to 50 times that NOI. And that usually you get to experience properties such in triple net when that have 2% cap rate, and you'll see that 50 times valuation. So highly sought after. Very nice. Yeah.
yeah. You've been quoted saying ROI is basically trash when you're starting out. and that gets people's attention. Why can ROI be misleading early in an investor's journey?
So ROI, return on investment, right? I would say returns are trash because of what I mentioned before. 99% of us are not born with a silver spoon in our mouths. We have to save up to $100,000, and that takes some time for people. But even let's say that you put this, you're able to save and you put this $100,000 at play at a 10% return, which is actually a very good return. That's about $800 a month. You're not going to be rich off of $800 a month. You're not. It usually takes about $1 million plus in order to start living off of your return. And in order to make $1 million, you need to think about investments that make many times your initial investment. So a 2x or a 3x investment rather than a simple return that makes 10%, right? And so you need to identify these. If you are serious about wealth generation, then you need to think about investments and learn about investments that make many times your initial investment. And for that, you need education.
What common mistakes do beginners make chasing high returns?
I'm sorry, what was the question?
What common mistakes do beginners make chasing high returns?
I would say the lack of education. Just because you see something shiny across the cliff doesn't mean you should jump and grab it, right? You should first learn how to make a bridge, and then making a bridge also takes its difficulties. And so definitely learn how to make that bridge so you can get to the other side and grab that shiny object. If you don't, then you can obviously fall in the cliff, and your financial life takes a dive.
Yeah. How does long term positioning outperform short term ROI chasing?
Long-term positioning, I would say that's obviously more in commercial real estate. Short-term gains, I would say you call it, for example, home flipping. Anything done under a year, yes, it can be very valuable, but you have to have a consistent flow of income. And so you have to have many homes that you have to purchase and many homes that you have to sell. So it's a continuous operation. At some point in every flipper's life, you start questioning whether you're working for the homes or the homes are working for you. Did you buy yourself a job by waking up early and going to these job sites just because you want to keep that money turning? Or did you invest in an asset that's automatically going to make you any money, make you rents? Is it going to value itself just by raising the rents? So you have to kind of invest in your own business, as Tony Robbins says, right? You should operate your business, not let the business operate you, right?
Love him. Big fan of him. I did his university from A to Z, all of his courses. He's
Yeah.
one of the guys that got me into got us where we are with his book, Money Master the Game. That's when I started investing, first in stocks, of course, and then real estate, and then so on and so forth. As the money grew, you get to more investments. These are some metrics, if you could touch on them a little bit, like bases and debt structure, risk adjusted return, scalability, and liquidity.
You want me to touch on these? Okay, on those forms. All
Yeah,
right.
it ties in with the ROI chasing a little bit.
I'm sorry. Which one in particular would you like me to talk about?
I think basis is an important one. Risk adjusted returns is important, and I think liquidity in a lot of ways is really important as well to be able to purchase new product if you see something out there. If you could touch on those in your mind, because
I am a huge fanatic of liquidity. I do not subscribe to the school of thought that liquidity or cash in your bank is trash and you should put it at play. You have a lot of the big names in this industry, like Grant Cardone, that says cash is trash and you should just leave it in an investment and you should make it return. But even he knows that he needs liquidity in order to keep on getting loans.
well, he gets his
Liquidity,
liquidity through his funds.
right?
So his cash might be invested and making him money, but he's using other people's cash. He
So
has
he tells you to
liquidity.
invest in him. Yeah, I get what he's getting at. But yes, so you have to actually know how to operate, how he's operating instead of listening to his advice. I would say liquidity is the number one driver of scalability. You need cash in a bank, especially nowadays in the cash crunch days, to keep on borrowing, right? And to go from that 8 unit to that 20 unit to that 40 unit to the 100 unit apartment complex or what have you, you need to show strength. And that's usually how you show strength to the bank. It actually is more important than credit and net worth and all these other things. It's usually how much cash do you have. And obviously, a lot of banks want you to come and deposit it in their banks. That shows a lot of strength already. As far as risk adjusted returns, you have to consider risk. You have to consider what you're investing in and what kind of level of risk are you taking on. Commercial real estate is a very good one. Yes, commercial real estate is worth something at the end of the day rather than a stock that goes up and down. I would say you're trading a lot of elbow grease when it comes to investing in commercial real estate versus just staying in the stock market. But that something that you're willing to invest in? Are you willing to invest your time? Are you willing to invest in your own education, stuff like that? I would say it does require a lot of education. It requires a lot of time, and if you don't have those or you refuse to get those, then you're not going to be successful in commercial real estate.
Wow, great, eye opening. What separates sophisticated investors from beginners?
Sophisticated investors know for a fact of these last two things that we talked about, which are that liquidity is important and that risk adjusted returns are important. That's how hedge funds operate, right? They invest in both high risk, high reward plays, and they invest in low risk, low reward plays. That's literally what a hedge fund does. And so if you learn how to diversify yourself, learn what are the risks that I'm potentially taking on by investing in such and such investment, and actually weigh those mathematically, then you'd what I call a sophisticated investor.
And how should investors think about capital structure as they scale?
How they think about capital structure, I would say, not to repeat myself, but yes, you do
How
need
should they
liquidity.
think?
How should they think? They should definitely think about liquidity. They should definitely think like a bank. What is the worst that can happen? If you've been about around banks and lenders enough, you start automatically thinking like they do. What is the worst that can happen, and how do I cover my bases by making myself look good? You want to be that guy that your banker talks about during a loan committee as this guy knows what he's doing. And so the smarter that you schedule your capital and your liquidity and so on and so forth, the better investor and the more highly scalable investor you're going to be.
And what does responsible growth look like in a volatile market?
Responsible growth, that's very important. Don't over leverage yourself. I've recently started playing a lot with paid off properties where I would just get a big payday from a property that I liquidate and I go and buy other properties completely cash. I would say that is for sure not over leveraging myself because I'm not leveraging myself at all on those properties. You're investing in a hard asset that makes cash flow that you can play with, how much cash flow you're going to be bringing in at the end of the day. But even if you're not a fan of complete paid off properties, I would say don't over leverage because it's in this day and age very easy to do it. Rents fluctuate more than you think. And so the cash flow fluctuates more than you think. There's folks go through periods of scarcity and your tenants will have that as well. And so you need to be prepared for that. Try not to get anything over 50% LTV. That is the first indication that you're over leveraging yourself.
Oh, 50%? Okay.
I would say so.
Off of the top of my head, when you're getting a DSCR loan, 25% down, 75% is the loan amount. That's not a good deal. You should go 50-50, 50 loan, 50 in.
I wouldn't say necessarily because you have most properties out there are value add in some way, shape, or form. If 25% down is what you're giving, then make sure you have a plan to get to 50% LTV as quickly as possible, right?
Okay.
Most people that buy a property are not going to keep it just as is. They have some kind of plan for growth. They have maybe the market rents are low. Maybe you could get some Section 8 tenants that pay more. Maybe you can increase that in this tenant. And so if you have that kind of plan in place to get to the 50% LTV, you're going to be the stronger investor.
Gotcha. What role does patience play in long-term success?
Very much, especially right now. Patient investors are the ones that end up winning. You can't be emotional. You cannot let yourself be desperate to get a deal. If you have a lot of dry powder out there, I would say where right now would be a great time to deploy it. But if you're having analysis paralysis, which is the other side to this equation, right? If you're just looking a deal after deal and you have some cash sitting there, it's not doing anything. That's not liquidity. That's dry powder. That's not doing anything, right? So if you have complete balance between liquidity and you have a deal working and you have a proper LTV, that's proper balance in investing. So you have to make sure that you're either or, not just jumping at the chance to get every deal out there that seems good, and not make sure you take some action so you don't have what is called analysis paralysis and you actually get a deal that looks good on paper and then you can execute.
Okay, let's do some rapid fire questions. Quick answers, quick questions. One metric you never ignore.
What? I'm sorry, you were cutting off what?
One metric you never ignore.
Metric to never ignore. And when buying a property,
One metric, yes.
price per door.
One red flag you see instantly.
Severely under market rents.
One habit every serious investor must develop.
Creativity in rehabbing, financing, and structure of the deal.
That's awesome. That was it for the fire round. For anyone listening who wants to sharpen their underwriting and decision making, where can people learn more about Rady AI?
So please sign up to be a beta tester at Rady.ai, REIDY.ai. And you'll have a very nice video that breaks down everything that we're planning to do. Rollout is about 3 to 6 months from now, God willing. And yeah, we're looking forward to hitting the market hard, and we're going to be nationwide from the jump. And like I said, God willing, we'll be very successful doing so.
Who should absolutely be paying attention to this platform right now?
I would say anybody interested in real estate investing, and even if you want to be a partner in our venture, please reach out to us. We would love to talk to you and get to know you first. Yeah, so yeah, I would say this app is a revolutionary way to look at real estate. It is made for commercial investors. I'm sorry. It is made for real estate investors from real estate investors, solving a lot of problems that you're going to see as a real estate investor. So please check us out.
I am signing up for that beta version, guys. Today's conversation is a masterclass in thinking bigger, deeper, and long-term in real estate. If you got value from this episode, make sure you're subscribed to Real Estate Roundtable wherever you listen to podcasts. Share this episode with an investor who's still chasing ROI instead of building real wealth. You can connect with Boris Sanchez on Instagram and be sure to check out Rady.ai if you're serious about improving your deal analysis and investing efficiency. As always, I'm Lancelot Lenard, and this is a Real Estate Roundtable where we turn insights into action. We'll see you on the next episode. Take care, everybody.
Thank you.
Thank you for joining us on Sir Lancelot's Real Estate Roundtable, where we've unveiled the mysteries of real estate together. Remember, in this kingdom of possibilities, every dream home is just a discussion away. I can help your real estate dreams come true. Just call me at 786-449-7518. Until our next roundtable, may your ventures be prosperous and your homes be filled with love and joy. Farewell, fellow knights of real estate.